And when I showed something similar to a group like yours this past spring, not that long ago, they thought what we were trying to demonstrate was our worry about rip-roaring inflation. Now, when I show you this slide, which shows a price decline in the United States in 2009 of 1% and declines in most other nations as well, I think most of you are saying, well, we think the biggest challenge is deflation. So within the course of only 6 to 9 months, many investors and many business people have gone from one extreme, fearing rip-roaring inflation, to the other extreme, fearing the extraordinarily negative consequences of deflation. Our belief is that we are not entering a period of dramatic deflation. We do not think that this will be the 1930s revisited. Granted, inflation will be down in 2009. A good deal of that is related to commodity prices. But a true deflation is when incomes deflate, not just for a few quarters as we expect, but for a multi-year period, and that is not our baseline forecast. In 2009, we expect inflation to be so low that central banks will be able to do whatever they wish to with regard to interest rates. And we do believe that in 2010, particularly in the second half of the year, inflation will start to move somewhat higher. Well, what about those financial markets? Let me begin with an unhappy but true picture. This is the S&P 500 going back to 1995. And you can see that we really haven't made that much progress since then. You can see the movement up in share prices from 1995 till the top of the previous bull market in early 2000. It then fell dramatically until early 2003. We then had a rally until October of 2007, and then we moved back down to those low levels. One of the things that I'm certain that people in this room understand is that the price level itself is not sufficient information to make a determination as to whether stocks are too high or too low in price. You need to think about the price relative to something else, perhaps relative to earnings, as in a price-to-earnings ratio, or relative to sales, relative to book value, or in the models that we prefer, looking out a few years, because after all, stocks should be reflecting the multi-year return that you get from owning a piece of the action, owning a piece of the balance sheet, potential cash flow and dividends, and so on. We have a series of 7 different models that we look at. And based upon all of these, our conclusion is that the U.S. stock market is underpriced today relative to the fundamentals. Now, I told you before that we think that this recession has many more months to go. We think that unemployment has at least another year to go. We have the lowest profit forecast on Wall Street for the S&P 500. Even so, we believe that the fair value for the S&P 500 at the end of this year is somewhere between 1,100 and perhaps 1,200. Certainly not back to where we were in October 2007, but nevertheless a reasonably good return over the next few months from current levels. But price performance is only part of the story of what has happened over the last year or two. Before I turn to that story of volatility, I'd like to show you the performance of markets around the world. The U.S. market, by the way, was one of the best performing markets in 2008. I know there was still a negative sign in front of it. The U.S. market down about 34% on the Dow, but take a look at the performance of other markets, all much worse than ours, and Russia takes the prize, having been down 72% through the end of 2008, and by the way, down some more over the last couple of weeks. But price is only part of the picture. The other part that we need to talk about is volatility. On this particular snapshot, I'm showing you volatility in markets around the world. Not just what did the prices do, we all know that they went down, but rather how did they go down? Was it calm, steady, or was it volatile? It was volatile. In fact, by many measures, this was the most volatile period in global equity markets. I think you can see that very clearly. What may not be so obvious is how closely tied, how highly correlated volatility was from one market to the other. So not only did we see all markets go down in price, we saw that the volatility was very closely linked, and that is unusual. Normally, for example, large seasoned markets like that of the United States, the UK, and some others have volatility that's 1/2 or 1/3 that of emerging markets. But that didn't happen in 2008. There are many reasons why that may not have happened. At the top of our list has to do with the tie-in between global liquidity. When investors in the United States, for example, became uncomfortable with their domestic portfolio, they brought money home, saying, if I'm going to lose money, I'd rather lose it at home. This was especially true of many professional investors who didn't want their clients at the end of the year to say to them, why did you lose so much money in China or Russia? There is a perceived safety factor in terms of bringing the money back home. But there are two anomalies with regard to volatility. You take a look at how high that volatility was last year, and I'm going to show you the volatility just for the U.S. market. Take a look at that. This chart goes back to 2004. You can see that the price changes were jumpy prior to that, but look what happened in 2008. Using a volatility measure, standard deviation of daily price change, some people call this the VIX, it got up to about 85%. Now don't worry about the calculation, just keep in mind 2008, 85%. That was an anomaly in terms of how high it was, but the average for the United States is about 18. So we had an average of 18, we were at 80, 85, but the other anomaly that you can see on this slide is the very low volatility of 2004, 2005, 2006, in which the volatility wasn't 18 and it wasn't 85, it was 8. And I'd like you to think for a moment about the consequences of that sort of low level of volatility. It makes us feel comfortable. It makes us feel more comfortable than we should. And so in an environment where volatility was low in the U.S. equity market, in global equity markets, and global fixed income markets, investors were willing to take on more risk because they didn't see the usual jumpiness in prices. We believe that the mispricing that occurred was in fact more significant in the world's bond markets, fixed income markets, than it was in the U.S. equity market. Let me show you a picture of the U.S. corporate bond market. These are spreads. So these are the yields paid by corporations of different quality level, versus treasuries. And you can see the same few periods that I showed you previously with regard to volatility. Between 2004 and 2007, the spreads in U.S. corporate bonds were at historically low levels over treasuries. Investors were willing to buy lower quality bonds without demanding the usual increment in yield. Now, it wasn't so bad